So now, that's the past. Let's look forward. I did cut 3 slides out of that. That's the past. Let's look forward. So 2017 outlook. Well, what we know is we've been in this economic recovery period since the Great Recession for quite a while. In fact, it's really now the 3rd longest post-World War II expansion, but it's also been the slowest. And so what's happened is we've developed a huge gap between what the economy has produced and our long-term trend rate of growth. So we're really $3 trillion behind where we should be based upon our historic growth rate. Well, the monetary policy has proven not really to be enough. Now, I actually give the Fed some credit. They've really been the only game in town for quite a while. They pulled 3 rabbits out of the hat. First, they took interest rates down to 0. And then they printed a bunch of money and bought a bunch of bonds to take long-term interest rates down to 0. And then as you saw last year, they were compensating for dysfunction in Washington and trying to goose the economy through a dollar devaluation policy that they would never admit to. But that didn't end up being enough, so we all went to the voting box and we elected that guy. And we did it because we're greedy and we wanted some fiscal stimulus. And so the campaign promises, just to orient you here, this is Donald Trump on the left, Paul Ryan on the right. So supposedly we're going to get $1 trillion worth of infrastructure spending. We're going to add 4 or 5% to the defense budget. We're going to bigly cut taxes. And according to Donald and a group of CEOs, we're going to cut regulations like 75, 80%, which is great. And then there's $1 trillion that's held overseas, mostly in Apple's pockets, but we're going to repatriate that without consequence, and that's going to goose the economy. So the reality is, if all of that stuff happens, there's going to be more economic growth. So here's a forecast that I kind of cherry-picked because I liked it. For status quo, so this would have been had Hillary been elected, we were probably still going to see some growth going into 17 and 18, but should the Trumponomics package pass, the estimates for growth rise considerably. Specifically, if you look at 2018, there's almost a 1% gap. Now, that's a pretty rosy scenario, but hope it works out. Now, if economists are going to take up their growth estimates, that means that markets are going to take up their inflation estimates, and we saw inflation surge post-election. And if inflation's going up, then, or expectations are going up, then you would expect interest rates to go up. Here's the 10-year Treasury yield. Yeah, that's gone up. And with the rise in the 10-year Treasury yield relative to low interest rates overseas, that puts pressure under the dollar. So going back historically, the dollar surged 25%, which remember caused us a lot of heartache when the Fed overstated their intentions to tighten the economy. And then we sort of walked sideways here for a while. We got the Trumper tantrum, I'm calling it, where we got this reflation trade pushing the dollar level higher. Now, let's talk about what we think this means for markets. Well, if we look at the performance of S&P 500 earnings over the past 6 years, it's been kind of depressing. 25% sounds like a lot, but it annualizes out at a 4% annualized growth rate for earnings. Well, fortunately, the recovery in oil, the recovery in interest rates, which helps the financials, is going to goose the earnings going forward. And accelerating that even further would be the benefits of the Trumponomics package. So as is today, the expectations from FactSet are that earnings will grow 25% over the next 2 years, which is a 12% growth rate. That's pretty exciting. But when you add in the benefits of the Trumponomics package, the estimates could be 5 to 10% understated at this point. Because you'll get, this is KKR's work, but you'll go from a 6.5% maybe projected growth rate in their heads. You'll get the buybacks from all that money coming back, being repatriated. Steeper yield curve, good for banks. I know we got some bankers in the room. Bank stocks are up. And then you get a drag from the stronger dollar, but that gets more than offset by the benefits of the tax cuts. And so somewhere between 5 and 10% could be the addition to earnings growth 2017. So for our theme this year, we're going to call it basically shifting gears. We are going to go from monetary stimulus led by Janet Yellen to fiscal stimulus led by Donald and friends. We're going to rotate away, I guess, from this elite vision of globalization to nationalism. We're going to move away from economic redistribution to economic acceleration, from disinflation to inflation, from falling yields to rising yields, dollar weakness to dollar strength, chasing safety. I had some conversations out there with people saying, I want more stocks, to chasing risk. That's where we are. That's the narrative for you, Jeffrey. And then we go from sharing to winning, right? I kind of added that. In terms of the forecast on the year, then, we think the Trump policies, whether they get passed or not, at least directionally, are positive for equity, so we think they go higher. We do think that there's some jet wash up in large companies around regulations, Twitter risk, et cetera. So it hadn't happened yet so far in the year, but we'd bet on small over large. In terms of style, value stocks tend to do better in an economy that's accelerating, so we'll go with that. In terms of domicile, you know, America first is kind of what Donald's all about, so that may be where the investment opportunity is. But I would say that's dollar contingent. If the dollar strengthens, you want to be here. If it weakens, you want to be elsewhere. We've got feet in both camps, but more dollar heavy right now. In terms of U.S. interest rates, we think they go higher. In terms of bonds, because interest rates go higher, you want to own credit-sensitive bonds, not interest rate-sensitive bonds. And again, our call on the dollar structurally, economically, and based upon a border tax adjustment, the dollar wants to be higher, but we've seen Trump come out and tweet that maybe this currency is too strong, so the market's not real sure on that, but we're going to go with higher. The primary threat to this year is, while Trump may have a mandate, he still has to get through Congress for it to manifest, and these are some of his friends down there who are opposed to some of the Trumponomics that we've discussed.